we were talking before we came on too that we've been seeing the fixed rates dropping. There's actually now a pretty big variance between variable and fixed. In some cases, over 1%. Excuse me. Oh my gosh!
I'll get that
Great.
cough under control there.
In some cases, over 1%, which is wild. Usually, even a 0.5% difference where fixed is lower than variable is pretty substantial. But we also said that, I think, Dave, you mentioned it was about 70% of people during the pandemic over the last couple of years took variable. So I think now, with those interest rates rising, Bank of Canada increasing their rate again, there's a lot of people that are financially tight. The bond rates have come down. The Canadian mortgage bond has come down. So we're seeing fixed rates follow suit, and it looks like they're going to continue trending that way. So we might even see a larger disparity between fixed and variable, somewhere in the maybe 1.5 range, even in the coming weeks.
Yeah, I think we've got a graph up here. Definitely hit a high in June and earlier in the year. It's come down since. This is based on the 5-year bond, which is what drives the 5-year fixed. 2 and 3-year bonds are different bonds. Those have not come down, so they're just still elevated. They're high fives, like, your typical 2-3-year fixed are still in the high fives, where on an insured 5-year, you're kind of in that 4.69 range. So there is still a big disparity between those as well. But to your point, variable is significantly, that gap between variable and fixed is pretty immense right now, and certainly possibly growing. The latest increase, the Bank of Canada did outline that they were going to put a pause on things. However, soon following that, the U.S. Fed did a 0.5 point jump in their overnight rate. And Canada typically has to follow suit in a lot of cases, because otherwise it drastically affects the Canadian dollar. So even though they mentioned that they're going to put a pause on it and see how the economy takes shape, I think they do have to make some judgment calls based on how the U.S. is affected, and what those, what that inflationary and employment data is showing.
Yeah, and I should just to backtrack. I know we kind of assume that our listeners are as well informed, or at least as knowledgeable on the market as we are. Some may not know what, I'm sure they probably have heard of bonds. You can invest in bonds and so on, but the CMB, or the Canadian Mortgage Bond, essentially helps stabilize access to mortgage funding in all economic conditions. So the CMB program lets approved financial institutions pool eligible insured mortgages into marketable securities. So investors can actually buy these securities, and that generates funds for residential mortgage financing. So the CMB has a direct impact on fixed rates. You mentioned, Dave, like the 5-year has come down. I expect 5-year rates probably to continue to drop at least another maybe 0.25% even in the coming week. And I actually had a few people that we were in the process of, they haven't accepted offer, they're closing in April, but we're actually waiting because lenders at times will actually allow you to float down the rate. So if you lock in a rate today, and let's say rates drop in 2 weeks' time, some lenders will actually allow you to, at one time between the time you submit and the closing, you can actually float that rate down to the lower of the two rates. So I had a client who we kind of were having that discussion over the weekend, and they said, well, why don't we wait another week or two if you think rates are going to come down, so that we can submit and still have that extra kind of buffer of that one float down. So it'll be interesting to see how that impacts the landscape, especially if we're seeing such a huge variance, like 1 to 1.5% between the fixed and variable. How many new applicants are going to be going fixed as opposed to variable, which, as we said, was close to 70% of the last couple of years.
Mm-hmm. Yeah, I mean, all those variable clients as well, if they were adjustable rate mortgages, meaning that they fluctuate their payments along with Bank of Canada, they will have hit their, they will have continued going up. Other banks have a variable rate mortgage, which is a static payment, regardless of what happens with interest rates. But they do have a trigger point, meaning once the interest supersedes, what that overall monthly payment is, the bank requires you to increase your payments in order to meet what that requirement is and be paying down the mortgage, so it's not reversing the amortization. So in Canada, all of those homeowners have hit their trigger points. So either having to voluntarily or not voluntarily, forcefully increase their payments or make a lump sum payment. So we are seeing a lot of people looking into switching banks, looking at what fixed rate options are out there. But at the same time, I am still having conversations with people where variable still makes sense depending on what their plans are and what their time horizons are, because of just where the 2 and 3 year fixed is. They still think, they believe that variable will maintain status quo over the year and start dropping. So they're, still looking at that, or because of the penalties associated being lower, that they, maybe have plans to only be in that house for a year, 2 years, and still, so it still makes sense from a numbers perspective due to the penalty. So it does really come down to what that individual's goals are and kind of plans with that property.
Like we've said many times, it's like, make sure you know exactly what type of product you're getting into. Don't just get in for the lowest rate thinking that that's the actual best mortgage for you. Can't express how many times I say that to clients, when they're just shopping rates. It's like, shop for the product, don't shop for the rate.
Yeah, and compare apples to apples. There's a lot of ask the questions of, what the penalties are. Are there restrictions? Some of these low rates advertised online or by some brokers are restrictive. You can't refinance that out of that mortgage. You can't transfer to a different bank. The only way of breaking that mortgage is from a sale, and that's the only way. And even at that, the penalties are, some of them are even as high as 3% of the outstanding balance as being the penalty. So kind of looking at and asking what those restrictions are in that mortgage product, so that when you're comparing rates, it's not just one rate versus the other. It's okay, we are comparing two like products.
Thanks for tuning in, everyone. We hope you enjoyed today's episode. Please remember to like, share, comment, and subscribe, because we'd really like that.